for where it's at right now and where that goes into the future, some trends that we're seeing, and some maybe some trends of the past that will stop. And it's called Charting Disruption. I'll introduce our speaker here in a moment, but I want to dive in a little bit to our Compass team members. We have our administrative staff, Nancy Economist, Cheryl Hurst, Joe Waniger, Hannah Mason, Julie Greer, thank you, and our advisors, Steve Connard, Justin Van Houten, Caleb Pearson, Alan Holstein, and Michelle Bjorkren. So also, welcome to those joining us online. We have an in-person group and an online group. We're simulcasting this on Zoom, so thanks for joining us. And just to let you know what's coming on the educational calendar. So next month, we are going to have our annual economic update, reviewing 2024, what happened, and looking forward into 2025 and beyond. In March, instead of our typical estate planning meeting, we're going to approach this from the opposite end. We're going to approach this by how to inherit. And what I mean by that is, instead of planning how you give your assets to the next generation, we're going to talk to the next generation and say, hey, here's what it means to inherit an IRA or a life insurance policy or a piece of Iowa farmland or a company or all the things that people pass along to the next generation. So spread the word. That's in March. In April, we're going to have our Social Security, annual Social Security educational event. And in May, we're going to navigate college financing, which of course continues to be a very big deal. I want to introduce Kais Behrens. He is with Global X, a company that specializes in ETFs. And Kais, I want to talk a little bit, although it's not going to be part of the presentation today, I want to talk about what ETFs are and why they've kind of taken the investing world by storm. So we'll kind of hit that after the presentation, but take it away, and thanks for joining us today.
Sounds great. Hey, thank you, Guy. And thank you, everybody, for joining me. It's an honor to be here. The drive from Chicago to Iowa yesterday, I steadily saw the temperature drop. However, it's one that I enjoy coming out here. I have 3 nephews that live in Waukee. One of them, the oldest, is sophomore in high school. It's fun to see his growth and development. And truly, when I mean growth and development, he is 6'4", 240 pounds. His exit velocity is now 106. He's the #1 recruit coming out of Iowa. So it's really fun to watch him and his career path and chasing his sport, his dream of what he's trying to chase. But all 3 of them, great kids, great kids. So the Meeker family, you might see them running around town. There's always a natural draw to come to a spot where you have family. And it's great to be able to see them when I come into the town. The team that you're all working with, the Compass, top notch. I've known them now for 4 years, and some of the best certainly in the state of Iowa. But what they do for you all, not only in terms of investment management, but the things around the edges, the service aspect that's needed to help everyone feel comfortable with directions, the changes of the economy. They do a really, really great job. So again, it's an honor to be here. In terms of today's presentation, so I actually share a little bit about myself. I want to touch on just very briefly our company, Global X. But then I'm going to touch on a little bit of this research project called Charting Disruption. This is our big annual research project that we put on every single year. And I'll kind of get into the why behind it. But it's one that I'm excited to kind of look at what we did say going into the beginning of last year and what we think and anticipate going into this year. But quick background on myself before I jump into the company. So I guess address the elephant in the room. Where does a name like Kais come from? So actually my family's background is Iowa, but before that, Germany. So my grandfather, who I got my name from, Grandpa Kais, he was born here in the States. Older sisters only spoke German. So as a pet name, as a nickname, they called him Kaiser. They Americanized that into Kais, but that's where I got my name from. Now, a quick story about my grandfather. At age 12, so they had a cattle ranch out in Pocahontas, if you're familiar with that town, kind of northwestern Iowa. Every year, their annual income ultimately came from bringing cattle from Illinois or from Iowa to the stockyards in Chicago. When my grandfather was 12, at that time, his dad got pneumonia and was not able to make that trip. So initially, it was going to be him and his older brother Lester to make that trip over to Chicago together. Well, a quarter mile into that trip on the train, his older brother jumped out of the train and ran back home. So here's Kai's 12 years old, who is set to then go to the stockyards, which, by the way, at that time was not a very friendly place. It was a little cutthroat. He negotiated the price for the cattle, sold the cattle, took in the income for the family, but then subsequently said, when am I ever going to be in this city myself? Decided to stay the entire weekend. So I think about, as I have 3 kids myself, oldest 12, Jack 10, our little June is now 7. She just turned 7. Age 12, to make that trip yourself is mind-boggling. But I think that also talks to a little bit of just generational differences. My grandma Miller, who lived to 98 by herself in her own house, canned her fruits and vegetables. When my wife first met her, she said, plain as day, my wife Jen asked, how did you survive the Great Depression? She said, well, it's tough. None of you all would have made it. So very matter of fact. About our firm, so Global X, we are, as Guy had mentioned, an ETF-only issuer. We started in 2008, and a fairly unique entry into the space. So the 2 original founders did not come from a background in asset management. Rather, one was a consultant in the financial sector. The other happened to own a broker-dealer, but really is a multifamily office. Many of their clients were from countries outside of the US. At that time, they were investing in, and not to get into the nitty-gritty of it, structured notes. Structured notes were very inefficient from a taxation perspective. There's a significant tax advantage to invest in ETFs. So initially, they went to iShares, one of the large ETF providers, and said, we have pent-up demand, we have seed capital. If you build it, we will come. The reverse field of dreams. Well, at that time, iShares said this is too niche. We'll pass on this idea. Well, the 2 founders, late 2007, pooled the resources, pooled basically their collective wisdom, and they started Global X, first with single country offerings like Nigeria, Colombia, Norway, really for their pent-up demand of their investors. So it truly was reverse inquiry and client demand. Fast forward to today, we're $50 billion in assets. This is a little while ago. Over 100 ETFs here in the United States. We are a global presence. So we have ETF companies in South Korea, Europe, Brazil, as well as Australia and South America. So to that extent, truly a global firm. What we're best known for and what we're going to talk about a little bit today is thematic investing. This idea of how do you harness some of the ideas around infrastructure, some of the ideas around growth like artificial intelligence, cloud computing, cybersecurity, but it's really that which is what we dived into for this big annual research project. I'm not going to read verbatim. This is actually a pretty text-heavy slide, which I don't like. But basically, charting disruption was born out of the idea as we harness these kind of mega trends, if you will. And to give you a little bit of backstory from where we started, so we launched our lithium and battery technology ETF back in 2010. At that time, it was off the idea of mobile phone adoption. Now, fast forward to today with electric vehicles and how much that has propelled that theme forward. That was really the beginning. We launched then secondarily our social media ETF. We launched that before Facebook IPO'd. So I mentioned that because we were early in this idea of thematic investing, which is looking at forward-moving themes that are going to disrupt the existing landscape. Well, what's the biggest challenge to that is the information gap. How do we educate our investors around what these themes are, primarily, but then what is the direction that these are headed? Because it's not lost on anyone, the speed of adoption, the evolution of technology is happening at an extremely rapid pace, almost too fast. How do we keep our investors well apprised of what these changes are in the landscape? This is where this project stemmed out of. So we'll dive a little bit into this, but first I want to talk about how we look at thematic investing. So what this looks at, just to sum it up briefly, this is basically technology over time. A couple observations that you can take from this. Number one, there is a synonymous S-curve of adoption, and that is consistent across adoption of technologies throughout time. It could be electricity, all the way through social media, all the way through mobile phone adoption. A couple things to note here, and you may see shifts that do take place within that S-curve that can take place from outside forces. At that time, this dip, if you will, in terms of the adoption of technology, well, that happened to correspond with the Great Depression. What caused that outside force was that there was a seismic dip, if you will, in household income. Well, subsequently, you also can see there's periods of time, 2020, there's lines that we see here that are almost extremely vertical. ChatGPT, which was launched in 2021, it took just 2 weeks for there to be over 1 million users of that technology. So what we're seeing is what used to take place in maybe 40 to 50 years in terms of that adoption, we're seeing take place in 2 to 3. The rate of that adoption is very, very quick. And I think it's generational, right? So I look at my kids, and I guess fast forward to the next slide to give you an idea. These are some of the technologies that previous to where they sit on this line graph did not exist. ChatGPT being the latest one, but you also see smartphones back in 2007. Well, right around this time was Alexa. My wife during Christmas bought Alexa for me for Christmas. We open it up. The first things that the kids ask is, Alexa, play Justin Bieber. I'm immediately looking, how do I return this machine? But what's fascinating out of that technology that we saw was now I have, Jack at the time was 5. He's building Legos at the same time he's asking Alexa about dinosaurs. I also see fatherly wisdom dissipate in front of my eyes. So before school, it was Dr. Seuss Day. They asked me, Dad, what was Dr. Seuss's first book? I'm going to take a wager. I'm guessing at this one. I'm pretty sure it's Cat in the Hat. They immediately go to the machine. Alexa, what was Dr. Seuss's first book? And it was Mulholland, whatever it was. I was wrong. And they love the fact that they could go to Alexa and prove that is wrong. They use it almost daily, whether it's football facts that my son's asking, but it's fascinating to see their use of technology and how quickly they take the iPad and say, Dad, you're taking too long. Let me do this. This slide more so is talking about how that S-curve works and the very beginning stages. I'll use the example of electric vehicles. Electric vehicles started in the 80s. Now, at that time, they look like Franken vehicles, and they're powered more on fruits and vegetables that are put in them, and they might have driven 30 miles. The feasibility, the functionality was not there, but you had evangelists who believed in the technology and who were willing to pay up for the cost of that technology to ultimately utilize it. Where we get interested in themes ultimately is around this early adopter, early majority phase, because that's where you see that there's a difference in terms of the financial impact. You can see the parabolic growth scenario, and there's also an aspect that there's enough names for us to create an ETF. Not to get into the operations too nitty-gritty, but ultimately you need 20 names or 20 stocks for an ETF to exist. So in that sense, we're looking at kind of post-IPO, but after venture capital. So once you have 20 names and we look at it from a pure play perspective, how much Amazon do you need in a portfolio? Well, my guess is you all already have enough Amazon within your core. We don't need to double up on that, but rather we're looking for the pure plays within thematic. And then dive into the actual project itself. So for this section, we're going to touch on infrastructure. Quick history of myself. I started in 2008. I was with Deutsche Bank at the time. At that time, I was on the mutual fund desk. And my first day of production, to take you through quick history of, recent history of the market, my first day of production calling into New York wirehouses was the day that Bear Stearns went down. There was some very colorful language as I was trying to make very nice introductory calls of never call me again, followed by expletives. It was a fascinating entry into the market. But what I will tell you, learn very quickly, is more about the value you bring to the table. What is the capital market insights that you can bring? What's the value that you bring to teams like Compass that maintains a seat at the door? Research like this is one of those things that I think helps to maintain that. And then helping to broad message that out to you all, I think helps to maintain a level of kind of cognitive ability to understand what's happening with these overarching themes. Infrastructure from the very beginning that I was in the market was a theme. And I looked at the average scorecard that the US Army Corps of Engineers has given to US infrastructure. The average grade is below C-. Now, I didn't go to state school, but I will say C- barely gets you the degree, right? We're operating at a very, very low level in terms of our infrastructure. And we've seen, unfortunately, circumstances where that infrastructure has crumbled and cost lives. So since I began in the industry, going all the way back to 2007, this has been a theme that we've talked about. Not until very recently have we seen bipartisan support. So this became a big conversation for our firm back in 2016. We saw with that incoming administration, only one piece of legislature that had bipartisan support is infrastructure. Still took 4 years to pass it, but what we saw was a significant amount of spending bills waiting on the cusp for that to go through. We touch on just a couple of those marquee projects. So if we look, these are the projects that have come out of the IIJA, or the Infrastructure Investment and Jobs Act. That was passed in 2001, or 2021 rather. It's $1.2 trillion in total. We're currently only allocating a third of that to current projects. Some of those, and you can see $400 million towards the Golden Gate Bridge. This is retrofit. This is to maintain that bridge, to kind of backfill, if you will. The Port of Houston is almost $150 million. The Soo Locks, near and dear to my heart up in the UP, that's $650 million. The Hudson River is a whopping almost $7 billion investment. And then looking at the Orlando International Airport, I was just talking with Caleb before this. This one strikes a nerve because I just spent about 10 hours in the Orlando airport, unfortunately, because they need to do better they're going to get the investment. So I'm happy to see that one. But it gives you an idea of the size of projects that are coming through the pipeline. Take this a step further, two subsequent pieces of legislation passed directly after the IIJA. And that was the Inflation Reduction Act, that was meant to help with the supply chain issues that we saw coming out of COVID. But then secondarily, the CHIPS Act. We have, at our firm, I'll take a quick step back, at our firm, our head of investment and our head of research, his name is Scott Helfstein. It's not a household name. His background is fascinating. So he was a West Point professor from period of 2004 through 2012. At the exact same time that he's a West Point professor, he was a subcontractor, did not serve with the Department of Defense, was a subcontractor. Reason for being subcontractor, you can do a lot more when you're not employed by the Department of Defense. His job and his group, they worked out of Tampa Bay, was they ultimately, through the CIA, were sending Sanskrit and Arabic messages into bin Laden's inner circle. Their whole job was ultimately to piss them off, for them to respond. It was a phishing attack. We were trying to get bin Laden's inner circle to respond back to the messaging. Once they finally did, we all know the story of SEAL Team 6. So what's fascinating is Scott Helfstein will never tell the story. I heard roundabout from one of the gentlemen that worked on his team, but ultimately his discourse around the geopolitical risk that we see as a country is absolutely fascinating. Why this CHIPS Act matters so much is Taiwan. So if you look at Taiwan and the juxtaposition of where that sits relative to China, our country currently is in an economic Cold War with China. We are in a race to produce technology. Taiwan supplies 80% of the chips and semiconductors for the world. That becomes a very big challenge for the US in terms of our independence away from that. What this CHIPS Act does is it moves us towards independence. Now we're 3 to 5 years out, but it moves us towards independence from semiconductors, microprocessors, and all of those things that we need to power the economy of today. To get back on track, sorry for that side story, but to get back on track, if we look at the projects that are coming out of both of those, I think EV battery technology is not lost on anyone. All three of those states are largely the auto manufacturers that we're seeing. But then semiconductor, massive projects that we're seeing taking place down in Arizona, Texas, as well as New York. If you look at the amount of battery technology, so if we compare this to Europe, looking at the chart to the right, ultimately what we're looking at here is the amount of gigafactory. Now, what is gigafactory? Those are the components. Those are the materials that are used with an electric vehicle, electrification, grid technology. We were well behind that of Europe, almost 50% behind Europe, going back even as recently as 2022. We just recently surpassed that of Europe in terms of production. So again, you think about the amount of projects that are being put online, it is a rapid pace. Here we're looking at a couple of the specific projects that are coming out of the IRA and CHIPS Act. Most notably, and we touched on this one, why it's meaningful, Taiwan Semiconductor is building a massive plant down in Arizona. 40 billion is the investment for that. That again moves us towards the independence from microprocessors and that type of technology. If you look at what that means in terms of manufacturer spending on construction, so this is average construction, this orange line. If we look at that juxtapositioned next to that of manufacturing, we're seeing a manufacturing renaissance take place, where we're seeing a 200% year-over-year increase in new project starts on manufacturing. Why that matters? If we take, and actually I'll jump before head one, if we take a look at the history of the US economy, for 80 years, industrial production represented the economy. Starting in 2000, we saw stagflation, at least from an industrial standpoint. We're looking to turn that back online, and we're doing this spurred through the IRA, IIJA, and the CHIPS Act. Here again, we can see cumulative change in construction spending. And looking at this, you see meaningful growth. Highways and streets, roughly 40%. Healthcare, just north of 20%. But if you look at the manufacturing increase in this parabolic growth, nearly 100% increase purely from manufacturing. So again, we're taking a look at the industrial revolution that we saw take place over 80 years. Our viewpoint is the implementation of technology is going to spur a second industrial revolution here in the United States, and we're already seeing it take place. Here again, we look at, so this is interesting, we looked at earnings calls. The number of mentions on the chart here on the left is the number of CEOs and analysts that have referred to one of these three pieces of legislation, whether it's the IIJA, the IRA, or the CHIPS Act. It went from 2021, under 100, just shy of 900. We're well past 1,000 mentions on those calls. So again, you look at what's spurring growth. Clearly, the amount of stimulus going into the system from those three legislative acts have created a significant amount of upside in that space. And it's the same thing that we're seeing here. Again, this is construction spending relative to manufacturing. Again, you can see the correlation between those acts being passed and again, the parabolic state that we're seeing in terms of manufacturing construction.
So guys, just a question for you here.
Yes, please.
What I'm hearing is that we're spending a lot
Correct.
on construction.
Correct.
And I also heard the time frame of 3 to 5 years. So when those two legislative pieces were passed in 22, was it?
Yep, 21, 22.
21
Correct.
and 22. So we're nearing that 3 to 5 year time period soon.
Correct.
Are some of these projects coming online? Because we're seeing the spending on construction. Are we seeing the finished product yet?
Finished product, that's a great question, Guy. So let me take a quick step back in terms of peak spend, right? So again, we look at IIJA, $1.2 trillion, 400 million of which, a third, has been earmarked towards current projects. Those projects typically take anywhere from 10 to 15 years, right? So in terms of the spend itself, earmarked and set aside for those projects, but in terms of implementation, not yet. When I talk about peak spend, that's when we're going to see the vast majority of those dollars of that stimulus being put towards action. However, it's going to still take another 10 to 15 years for those projects to actually be put in place. It's a great question.
This type of spending does remind me of, I'm a big history fan, so I read a lot about the westward expansion of the United States. And there was a lot of government intervention in the westward expansion, from subsidizing railroad systems, subsidizing electrical systems when they became a thing. And so the government at least has a long history of getting these big things kickstarted. And I think everybody in this room would agree that, hey, having all of our chips made across seas can be a bit of an issue, especially when we have a big antagonist in China that's on the other side of this. So there's a reason behind all these bills and all these spending is to bring some of these manufacturing capabilities back to the US. And that sounds like it's happening as we speak.
I wanted to couple and add on to some of what guys were. If you look at investment, the best ROI from federal stimulus It's infrastructure. For every dollar injected into the system, ROI actually surpasses that at an estimated 1.2. So you actually see you don't just back your investment, your investment back to us. And I think that that's where the government. This is the direction that we're headed with it. EV stations. It's a great point the guy brought up, and actually it's timely in terms of this next slide. I won't spend a whole lot of time on this, but as you see the growth and adoption of electric vehicle, there's a need for grid build out. There's a need for those charging stations. All these charts are pointing to is that expansive growth. Here 2023, where we are expected need by 2030, there's a major gap there. How do we get there? It's through the construction of these. And I think that several of these companies that we're talking about from an infrastructure perspective will benefit from those.
Stay on that slide for a moment, if you would. We just had a conversation this morning in the office here. I asked the question, when's the tipping point going to come in Iowa with electric vehicles? And one response was, Guy, it might not be batteries that are the next big thing. It might be something else. And having this long-term history of innovation and change, nothing is ever staying the same in our economy. It might very well end up being hydrogen cells that make the next huge S-curve, or some other new technology that we don't know about yet. But I have great confidence in the United States and the world, the creativity to bring these new products to better our society.
100% with you. One of Scott Helfstein, our director of investment, one of the things that the major difference of the US economy relative to China, we create, we innovate. They do a very good job of copying. But our ability to innovate, that is a very unique American way. And I think that that's what keeps us at the forefront of technology. And then last would be grid. Here's what I'll point to. If you look at where we were less than 10 years ago in terms of historic grid investment, again, we're looking at a 50% increase already in terms of that expectation towards the grid. What this means is more meaningful power supply. I think that we're looking at nuclear, solar, wind, but we're definitely moving into more of again, an industrial revolution around that. So with that, those are my prepared comments. I'm going to open up to any Q&A that we might have.
Well, let me talk a moment about energy too.
Please.
Because I just read a report from the Energy Institute, basically Worldwide Energy Institute, and the points that they came up with is it's not one type of energy or another for the future of the world. It's all types of energy are needed. And not only that, we are using more of every single type of energy, be it coal, be it wood, be it natural gas, alternative fuels, solar, wind. All of those sources are being used in a higher volume today than we ever have in our future or in our history. And in the future, we will need all of those to meet the energy demands of not only the US, but the world too. And in third world countries, when they have an extra dollar, what do they tend to spend it on? They spend it on things like energy, electricity, make their lives easier, to make themselves more productive at work. So energy is one of the first things that we spend our extra money on because it improves our lives. So there's a lot of work to do there. And interestingly enough, the more we look for energy in our world, below the ground, in the sky, the more we find, which I think is a wonderful gift for us to get to the point where we may not need oil anymore in 100 years. I don't know. But that's the beauty, is everything's changing, and it seems to be going in the right direction.
100% agree with you. Yeah, and the rapid pace of these advancements is mind-boggling, is the reality. Yes, question in the back.
I lived in Texas in the 80s, and back in the 80s, you talk about chips and that, at that particular time, Texas Instruments, Intel, there were a number of startup companies in the Dallas area, I know, that were doing semiconductors, and we were the leading in semiconductors at that time. Fast forward to today, what happened? How did things shift to now we got to catch up again?
That's a great question. And you hate to point the finger at one in particular. However, debate's out. There's a lot of investment going into Intel. So Intel was the leading semiconductor processor at the time. They dropped the shoe, unfortunately, and Taiwan picked that up and they ran with it. There is a huge national interest in us finding a way through Intel. However, a lot to be said, can their leadership bring them there? I think what we're seeing within Arizona and Taiwan Semiconductor, creating a plant there, it's intellectual property. Bringing that to the States and reshoring that is meaningful in terms of, again, our independence from a chip perspective. It's a great question. Yeah, unfortunately, we dropped the puck on that side. We were the global world leader in terms of semiconductors and chip manufacturing, and that did fall.
I will tell you a story of the most complex machine in the world. It's manufactured and operated by a company in the Netherlands, because this is an idea that went way back to the 80s that a US scientist had, and he got laughed out of the room at the time. So he came up with this idea, and with the help of the US government and other chip companies, eventually over the course of 40 years made this idea a reality. And what they're doing now is they're shooting lasers at molten drops of tin, and that is etching millions and billions of circuits on microchips at a time. And they're doing this 50,000 times a second. And these machines cost $500 to $600 million, and they fit in a room this size. This is the amazing stuff that's going on that we have no idea about in this room, just the normal person. That's how they're making chips now. It is amazing. And I'll tell you what, someone else has an idea today that will morph into the next amazing thing. And it may take 20 or 30 or 40 years and a lot of money, but that's how progress happens. And that's why I have such a high level of confidence that we are going to find our way and make the things happen that we need to happen, especially here in this country. Especially here in this country. Questions for Kais? We had one, Kurt? Of course, you would have a question.
I think I'm going to convert into the Amish community after this presentation. Horse and buggy looks pretty good to me. I don't know. My question is about the electrical grid. And in the press conferences that I've watched recently, there are hundreds of billions getting invested into AI cloud storage.
Yep.
And new data centers.
Yep.
In the country. It's just been announced. And if I heard things correctly, those companies are also building electric facilities to handle, so they aren't a burden on the electrical grid as it stands.
Yep.
Is that a trend that is new, or is it the first time I've heard of it? And do you think that that idea will continue? And perhaps this legislation supports that idea? I don't know, but I'm interested in your comment.
A great question. So it's been happening for 2 years now. And ultimately, what he's referring to is the data centers needed to store the data, the technology from largely AI, but ultimately the large information centers in the world. Virginia is one of them in particular that is a challenge because that happens to house a significant portion of the data centers in the country. I think largely that's out of national defense. But the challenge there is what do you do so that you don't drag down grid for the general populace? What we've seen actually is nuclear. So we saw with AWS, 3 Mile Island just got turned back on. What we're seeing is this adoption into nuclear and small modular reactors is kind of the technology that we're seeing going forward. So last year, mid-year, AWS purchased a nuclear power plant directly next to a data center. This is genius. Nobody wants to live next to a nuclear power plant. Well, last time I checked, people don't live in data centers. So they simply are connecting the pipes to the energy. I think that the nuclear side is very fascinating. Actually, Guy touched on it. Energy from all over, right? Energy from solar, energy from wind. Certainly we see that as we're driving. But you're also going to see nuclear is going to be, in our opinion, that's going to be the free way of energy on a going forward basis. And you can even see it in Japan, right? Japan in 2012 witnessed Fukushima and that disaster. They as a country has taken a 180-degree switch on their development of nuclear energy as well. You're seeing that across the world. So our view is nuclear probably will be that next step, and also will help to take off some of the grid challenges that you're seeing take place. It's a great question.
I'll tell you this too, Kurt, that I read an article the other day about the new chip coming out operates at 60% energy from what the old chip operates at. So there are efficiencies coming to market right now battling that very thing, which means they can run 40% more chips on the same amount of energy with a new data center as they did with an old data center. And I've said it in this group at a past event, but I'll say it again. Right now, we have 17 Microsoft data centers in the Des Moines metro across 3 locations. In 5 years, we're going to have 90 across 5 locations. And Microsoft believe they've already sold all that storage already. That's the need that we have right now, and that is coming in the next 5 years. And we will rise as a city, as a state, and as a country, and I believe as a world, we will rise to meet that in a more and more efficient way than we do today. Question.
You may have already partially answered my question, but that is, how does Iowa fit into this picture?
Yep.
And does the state of Iowa even have a seat at the table?
So let me take you back to, real quick, the initial slide that showed some of the, here we go, the initial projects. What you'll see is population size of the state is largely going to determine the number of projects. However, if you look at Iowa, it's 609 current projects that are being funded or earmarked for funding, still a sizable amount given the size of Iowa. 3 years ago, I read an article, 5 of the fastest growing cities in America are in Des Moines. That is fascinating to me. But then when my brother-in-law moved out here with his family, and that was about 10 years ago, and he came out for technology, Des Moines is the Silicon Valley of the Midwest. If you think about it, what California is to the world, you're seeing, and this is unfortunate for residents of Illinois, we educate a lot in Illinois, and then they leave the state and they go to Iowa, right? More business friendly. The taxation is much better. Cost of living is much better, but they also have the space to do it. And last time I checked, they don't have a fiscal deficit like Illinois does. So for all those reasons, I think Iowa in particular is set to benefit from a lot of this. It's a great question.
So I would add to that, Iowa does have a place at the table for 2 major reasons. We have plentiful land, which is versus the whole country is relatively cheap. Okay, so big companies that want to come here are attracted by that. And number 2, we have relatively cheap energy in Iowa. And companies are attracted to that too.
And subsequent to that, last time I checked, Iowans aren't afraid to roll up their sleeves, i.e. they send 12-year-olds to Chicago with the stockyards to sell their cattle. So I think that also spells well. It's funny, anytime I have people from New York travel with me in the Midwest, the first question is this genuine niceness? And I said, yes, it is. We don't let assholes run around the Midwest for the most part. But then secondarily, they do see there is a humbleness to the education, right? It's unspoken. It's soft-spoken, but there's a high education within the Midwest that I think the East Coast sometimes forgets. It's a great question.
Good workers, good labor force. Let's transition a moment to ETFs and
Yep.
get back to that discussion. And we can show you charts, and it's quite amazing. The shift in the investing world from typically mutual funds to ETFs over the last 10 to 15 years has been staggering. And almost most of the new money flows goes to ETFs. So number one, what is an ETF?
Yep.
How does it compare to the old style of mutual funds? And what are the bonuses or what are the pluses and minuses of choosing an ETF?
Great question. At broad view, they are both pooled investments in essence. And the reason that a mutual fund was created was to democratize, and I'll trim that word down, to make available for the broad public multiple stocks. So rather than spending $1,000 on the time at IBM, you're able to buy a pooled investment in a mutual fund for that same $1,000. Now you can own 500 stocks. So it's a pooled investment. At base case, they operate and do the exact same thing. The major difference, taxation, and I'll dive into that. You get in the can of worms pretty quickly, but there's a tax advantage that's pretty meaningful for ETFs, but then also the ability to trade intraday. Those are the two major differences. So ETFs began in 2000. The first was issuer State Street SPY, SPY. It was the S&P 500. The initial reason for creating it was an institutional trading vehicle. They were able to trade, in essence, overnight, but also they saw the ability to trade intraday, again, pool of 500 securities all in one basket.
So,
Now-
so by institution, you mean big pension funds.
Pension funds, endowments, those types of things. The value of that was they were able to do at a similar cost what they had to do individually, buying stock by stock by stock. They're able to get those large entities out. Now, the taxation difference, and I'll try to tread this water, in a mutual fund, if somebody at your table were to sell out of that mutual fund, there's a capital gain that other people in that pooled vehicle are held accountable for. Now, I saw this at my time at Deutsche Bank. So in 2012, I was the first to join their ETF distribution. I was part of their mutual fund distribution before that. They had a mutual fund that was largely held by one institution, but then a lot of retail mom and pop investors held the rest of it. Well, that institution decided to liquidate in November of 2013. The remaining investors were held culpable for a 50% capital gain tax because that institution left. Now, to me, that doesn't seem like that's equitable. The ETF, you're not held in accordance to other investors when they buy and sell, right? So there's a major tax advantage to that. It's really only your trajectory of when did you buy and when did you sell, your own experience of ownership of that ETF. That was the major reason why, and ultimately how we're seeing this tidal wave of assets flow over to ETFs. Now, if you look at last year, and last year was a 40% increase in total issuance of new ETFs. Well, a sizable portion of that was actually asset managers taking their existing mutual funds and they were morphing that into the ETF structure. So I think going forward, you're getting the same active manager, you're getting the same process. Now it's just in a more tax advantage vehicle. I think you're going to see a lot of that take place. Now, Guy did bring up another question. What are the pitfalls of?
One thing here. So
Yes.
the real difference is a legal structure of a mutual fund versus an ETF. Okay, that's how these changes came about. They're different legal structures. They typically behave in the same way. They have the same focus, and they can own the same things, and by and large act the same as far as price goes. But again, the tax thing is simply because of the different legal structures between a mutual fund and an ETF. There's a lot underneath there, but that's the basics.
Now, the last question is, so where would you see that there's pitfalls in an ETF that may not exist in a mutual fund? And it's going to come down to one term, which is liquidity. So ETFs, the ability to trade intraday, like it's a stock, that's a benefit. However, it can also be a little bit of a detriment to areas of the market that are less liquid, like alternatives. Alternatives might be something that you own for 3 months, but don't have a liquid market. Well, very difficult to do that in an ETF structure. So it's my belief, not only do fixed income still maintain their seat at the table within mutual funds, that existing wrapper, but in particular alternatives. I think you're going to see that the structure of mutual fund is a little bit more adherent to how that investment works. Again, not to get too far in the weeds, but it's kind of the way that we're seeing the landscape play out. But it's, again, you think about the development and the evolution of technology. ETFs are just that next step in the evolution of technology for investing.
It has been an innovation in the legal structure of investments that have greatly benefited clients because it's driven the price down. It's become a more efficient, tax efficient investment vehicle, and it trades throughout the day. So you have price transparency at all times. In a mutual fund, what they used to do is take all their holdings and add up the closing prices. And now here's the price that we're going to trade at, but only at the end of the day. Okay. Versus an ETF that moves in real time with the prices of all the underlying holdings. So again, an improvement. We think it's great, and we use a lot of ETFs for all those reasons.
Now, this is more for academics. There's periods of time. So the liquidity or the ability to trade in and out of ETFs is based on the liquidity of what they own, what stocks they own, or bonds, what they own. There are, however, unique scenarios where the actual ETF becomes more liquid than the securities that they actually own. And that can take place in a period of time. Like if you remember in 2013, the Greece market closed for about 2 months. Global X had a Greece ETF. That ETF became price discovery. What I mean by price discovery was for a 2-month period of time, that ETF became the Greece market. And in 2 months after the fact, when that market opened up, well, the ETF didn't chase where the price of those securities were. The securities, once they opened back up and their equity market turned back on, it went and chased where the price of that ETF was, i.e. the ETF became more liquid than what it actually owned. That's a fascinating scenario. That's a chicken or the egg type of a question, but we have seen that take place multiple times in the history of ETFs.
And one of the nice things that we like about ETFs is because they are used by the big institutions to trade and swap and buy and sell. So they're very, very liquid. In fact, often people aren't buying the underlying securities that the ETF owns. They just use the ETF back and forth. So very, very liquid market. It's been very good for clients. It's one of the things that continue to push the cost of investments down. So here we are at the end. Any more questions? Yes, Justin.
Just a quick one. Talking about energy and the demand that, the data centers around here have for energy and just all the new technology, AI, et cetera, semiconductor chips. All of these, like the infrastructure acts you're talking about and the money that's out there for these projects, like the slide we're looking at right now, how much of that or is any of that earmarked for energy structure, right? So these data centers or Amazon, they're parking it next to a nuclear facility to get the energy, and that's great for them.
Yep.
But still, just generally as a population, we need more energy. Are we updating that? Because I've heard that's pretty outdated too.
It's the actual grid itself, the structure, 100% correct. And that's what we look at really at this final slide, which is the amount expected earmarked has increased 50%. Just again, looking in less than 9 years. And we expect that to continually take place. Actually, on this chart to the left, this is baseline expected investment into grid. Here's how much is increased with the development of IIJA and the IRA Act. So again, to Justin's point, I think the amount of money expected to be put into grid technology, it goes hand in hand with infrastructure. It's a great question. Thank you. Yes, sir.
I had a friend once, thank you for your presentation, who said, let's get the hay down where the goats can eat it. What does this mean to me?
Yep.
How do I communicate with my agent here? What do we do?
Yep.
How do we take advantage of this?
Yep. That's a great question. currently the team is utilizing some of our ETFs, and thank you to the whole Compass group, and also thank you to you all. It's your hard-earned blood, sweat, and wealth that you're entrusting to the Compass team, and therefore they're entrusting some of their investment with us. So in a way, you already are, and
Yeah.
subsequent to that,
Let me answer that a little bit. So this big push into data centers, how is it being manifest right now? It's being manifest in the need for chips that has driven up some of the most prominent chip companies in the US, right? To really, really high valuations. And it's also being manifest in building, construction, which is most of what you've seen here. And so if you own a big broad index, you have benefited wonderfully from some of the big chip companies that have boosted. So this is the leading edge of what we're talking about. So that's a way to capture some of those things, is own the big names that are on that leading edge. Yep.
Guy, that's a great answer. You already have that exposure, is basically the base case. You're exactly correct.
So I'm going to wrap this up. Thank you for joining us today. I hope you learned something. I hope these events are beneficial and interesting, and we will continue to bring you these on a monthly basis. Thank you for being clients. Thank you for bringing your business here, and thank you for your referrals, because that is how we grow. Have a great day, and join us next month. Thanks.
Thanks, everybody.